Good afternoon, ladies and gentlemen, and thank you for attending today's webinar on the state of the markets. Your host and presenter, Jordan Deckman, will be sharing lots of information and insights over the next 40 minutes, so please grab a pen and paper to jot down some notes. At this time, I'd like to introduce Jordan Deckman, CEO and founder of Deckman Wealth.
Welcome, everyone, to our State of the Markets presentation. My name is Jordan Deckman, founder and CEO of Deckman Wealth. We are delighted to have you here today and look forward to sharing some very important information over the next 40 minutes. By the way, we are recording this presentation and will have a replay available for you. Without further ado, let's get on with our presentation. I'd like to draw to your attention to these disclosures. This way I can keep our compliance department happy. Here's what we're going to talk about today. What happened in 2016, what factors affected the markets, what's on the horizon, and what do financial experts forecast for 2017. Let's start off by talking about how to put last year's market into perspective. What happened in 2016? At the beginning of 2016, we were coming off a year when all of the major domestic indexes lost a small amount of ground. In January, fears about China's economy were so strong that the Shanghai index dropped 6.9% on the year's first day of trading. And the U.S. markets experienced their worst ever start to a year. By February, markets hit the bottom for the year before rebounding in response to GDP revisions and consumer spending improvements. Growth continued, however, not at a very blistering pace. 2016's major political surprise rocked on June 23rd, which we all know as Brexit. Few people expected the Leave group to prevail and the UK to vote in support of exiting the European Union. For 4 days, the global markets reacted strongly to this shock before stabilizing. But in 2016, we still had some curveballs. After one of the most divisive, hotly contested presidential elections in memory, the U.S. experienced two big surprises. Number one, Donald Trump won the election and the markets responded with glee, launching a rally that would carry us through the rest of the year into 2017. Ultimately, the year ended with all the major domestic indexes posting gains, and it was a far cry from the doom and gloom that greeted us in January 2016. Now let's take a moment to look at some of the individual sectors within the SP 500. This chart shows sector performance for the first half of 2016, and the second chart shows the sector performance for the second half of 2016. Do you notice any interesting patterns? For instance, let's look at financials, which was at the bottom for performance during the first half of the year, losing 3.05% in 6 months. Fast forward to the second half of 2016, and the financials became the best performing sector in the S&P 500 with a 26.65% growth. Information technology was the second worst performer at the beginning of the year, and then the second best by year's end. Utilities, on the other hand, had the exact opposite experience. It went from being the second best performer through June and the second worst performer from July through December. What do these dramatic reversals tell us? Diversification is key. Knee-jerk reactions could cost you dearly when sectors swing so widely. Investing involves risk and loss and possible loss of principal. No investment strategy can guarantee positive results. So what we've seen in 2016 was quite an eventful year in the world and in the markets. But let's dig a little deeper into some of the factors that contributed to the market and economic performance last year. And we're going to touch on each of these bullet points one by one. The first one is the labor market. In many ways, 2016 was a good year for American workers. We experienced our 75th straight month of job growth. Unemployment dropped to 4.7%, less than half of its peak during the Great Recession. We are finally seeing the labor market tighten and more people return to work and earn more money. While higher wages can affect corporate profits, they also drive consumer spending, which accounts for more than 2/3 of our GDP. Manufacturing. We hear a lot of bad press about U.S. manufacturing, but the reality is different when you look at it more closely. As you can see from this chart, manufacturing output is going up and will continue to go up as we look at the next slide. Another way to look at manufacturing as well as oil and gas production is to consider the economic value they create as compared to global GDPs. If you look at the value of U.S. manufacturing production, it would represent the 10th largest GDP in the world. That's bigger than India, Canada, Australia. And the U.S. oil and gas would be the 17th largest economy in the world. In some ways, 2016 was a tough year for oil. In February, crude oil bottomed at $26 a gallon, a fraction of its peak at over $147 in July 2008. At its most basic, there was simply too much oil on the market, driving prices down. By year's end, however, oil completed its biggest annual gain since 2009, thanks in large part to OPEC pledging to cut production in 2017. At the same time, U.S. oil production is improving, while the cost of producing oil drops, and it appears that energy companies are ready to expand what we are already producing domestically. In 2016, oil mergers and acquisitions more than doubled over 2015. We're still not back to the 2014 levels, but we take this as a good sign that the oil and natural gas industries are primed to grow once again. For years, an oil and natural gas production has increased. We've been closing the gap between oil exports and imports, and although the gap may have widened momentarily while the oil prices dropped in 2016, we are moving closer to oil independence. Yay. In fact, on December 31st, 2015, the TOT tanker, which is the left, it left Texas loaded with what may be the first U.S. crude oil export in more than 40 years. Then in February, the Asia Vision tanker departed with the first cargo of U.S. liquefied natural gas. As we discovered earlier in the presentation, fears about China's economy were largely responsible for the market volatility in the early part of 2016. Couple that with concerns about Brexit and further disruption in the Eurozone and beyond, you may start to wonder what's really happening with the global economy. Of course, global growth still has a number of headwinds, and you must really evaluate markets on a case-by-case basis. But I think this chart does an excellent job of showing that global growth is picking up. This Purchasing Managers Index is a heat map that measures growth and contraction in manufacturing. Red indicates contraction, while green indicates growth. If you scan quickly, you'll see that the January 2015 column has more orange and red than the December 2016 column. Look deeper, and you'll see positive progress for the US, UK, Russia, Taiwan, and even China. In other words, the data shows us that global growth is picking up rather than threatening to decline. Let's talk about inflationary trends for a moment. Inflation is a general rise in prices of goods and services and one of the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, generally speaking, modest inflation is better for equities than high or volatile inflation. If you look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the yellow CPI line jumps around too much more than the light gray core CPI line. That's because food and energy prices tend to be very volatile in the short run. Though the past doesn't always reflect the future, historically a sudden run-up in prices has often presaged or accompanied a recession. Note the huge inflationary spikes during the 70s oil crisis and the 1980s recession. As of November 2016, the headline CPI of 1.7% was well below the 50-year average and very close to the Federal Reserve's 2% benchmark. The Fed has a mandate to foster maximum employment and price stability, and they believe a 2% rate can help support accurate financial forecasting and decisions while preventing harmful deflation. Though we are confident that the U.S. economy is on the right track, we know that the stock market doesn't always follow the economy. One major indicator that we'd like to take a look at is the gauge of the economy's health, which is known as consumer sentiment, which essentially is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's a very important indicator because sentiment has a strong relationship with consumer spending, which drives 2/3 of economic growth. Sentiment can also tie to market performance, but in a more complicated way than what you may expect. While consumer sentiment may be a rational reaction to a strong economy, a high level can also be a sign of irrational investor exuberance when increased to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as vertical shaded areas, and it's not always the case, or is it? No, we can see that it wasn't the case in 1984 or 2004, but it did happen in 2000 and 2007. For 2016, we ended with December's reading reaching a 12-year high. Later in this presentation, we'll show you reasons why consumer sentiment and the markets look fair. But we will still keep an eye on consumer sentiment because it's an indicator that the market could trend downward. I like how Warren Buffett phrases it. Be fearful when others are greedy, and greedy when others are fearful. What does this mean for us? Don't get caught up in what others are thinking of doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. So what's on the horizon for 2017? Let's take a look at what headwinds and tailwinds we can expect in the economy in the near future. This year, our new presidential administration may bring many questions about the future, what the future may hold. We could find faster growth, better jobs, increased oil production, and more. If three things happen, number one, the stock market performs well. Number two, businesses continue to invest in the U.S. And number three, President Trump's policies accelerate the economy. In this case, we imagine future headlines touting major accomplishments accomplishments in a few years from now. On the other hand, if some of the potential risks and headwinds that we find catch hold of our economy, we may find a very different view in 5 years from now. Ultimately, no one knows or can predict the future, and in 2017, a noteworthy amount of political uncertainty is certain. We believe that to avoid emotional reactions during times like these, we must focus on the fundamentals. Look at what's really happening in the economy and analyze what the data is showing us. Whether real or imagined, headlines are only helpful if we take the time to critically and carefully look for the truth among all the hype. So if we take a look at the uncertainty along with the positive opportunities, do we have to worry about a 2017 recession? Well, let's look at a group of indicators that can help ground our predictions in data. This slide takes us back to early 2008. Here we see a group of 20 indicators that help forecast what pressures we'll be acting on in terms of the economy and financial markets over the next 3 to 6 months after the report. Green is positive for the economy, and obviously red is a headwind as an economic break. The dotted lines show where the indicator was in a previous report, while the full line shows the current reading. Here we are in January 2008, about 8 months before the Lehman Brothers collapse in September 2008. You can see a fair number of yellow and red indicators long before the recession actually started. The economic outlook was negative, energy prices were rising, and the housing market was a huge red flag. We then fast forward to December 2008. Red emerges on the board. The economy was in serious trouble. The housing market was deep in the red. Volatility was high. The global economic outlook was negative, and business spending was dropping. Now let's take a look at where we are today. The most recent update of these indicators. You see a lot of green on this board. The U.S. economic outlook is strong. Consumer confidence is growing. Business spending is on the rise. And many more indicators are showing positive signs. The only red on the board is coming from the political environment. Surprise, surprise. Given the uncertainty about our new presidential administration, how they'll govern, and what policies will come to fruition, this concern seems fair, for one which we have answers later as the year goes on. The yellow gauges are areas where analysts have some concerns, and we will continue to watch for developments, especially over the next 3 to 6 months. So we can see that global economic outlook and geopolitical risk appear to be greatly improving. The picture isn't perfect, but compared to 2008, I think you can see the difference in our economy's strength and potential. Now, the past cannot predict the future. The financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're pretty confident that we won't see a recession this year. The markets have rallied since the presidential election, reaching one record high or another, but investors are very euphoric. The question is, are equities overvalued? When we look at the slide's data, we see that the markets appear to be at fair value. There's a lot going on in this chart, so let's dissect what it's telling us. First of all, P/E ratio means the difference between a company's price per share, or P, and its earnings per share, or E. So the higher P/E ratio, the greater the difference between what investors pay for a stock and what the company actually earns. A high P/E ratio means that stocks are relatively expensive compared to what they're earning per share. If you look at the middle dotted line on this chart, you'll see that the average P/E ratio is 15.9 times. In other words, Over the past 25 years, stocks have averaged a price per share of 15.9 times their earnings per share. In the Great Recession, the PE ratio was far below the average line, where it was high above the average during the dot-com boom. For 2016, we ended at 16.9 times, nominally above the 25-year average, but well within one standard deviation above average. The data tells us that we do not appear to be in a bubble, and instead stocks are currently at fair prices for their earnings. Perhaps one reason for consumers' rising confidence is that their personal finances are improving. The percentage of debt payments people make compared to their disposable income has dropped, and the average household income net worth has risen. We've seen a rise in serious delinquencies on auto loans, student loans, but the total serious delinquencies have dropped greatly over the past several years. So overall, with rising wages, lowering unemployment, and increasing net worth, outcomes are looking up for the average consumer. After 2016's numerous surprises and ultimately good performance across most indexes, we look forward to seeing what lies ahead in 2017. As we discussed, we see many positive signs, some uncertainty, but we look forward to what we may experience this year. As we discussed earlier, inflation is currently at 2.1%, but what will happen in 2017? If you look at this chart, you can see that expectations for inflation jumped immediately following the presidential election. If President Trump is able to lower corporate taxes, increase infrastructure spending, and loosen regulations, or even just one or two of these goals, there's a good chance that the economy will speed up and inflation will rise. But even if inflation does rise in 2017, we don't expect it to reach uncomfortable levels. And the Federal Reserve still has a lot of room to adjust interest rates to help control inflation. The Federal Reserve seems to share our view, and that the economy and inflation may both grow in 2017. After interest rates increased in 2016, it was only the second increase in 10 years. Federal Reserve Chairwoman Janet Yellen said, "My colleagues and I are recognizing the considerable progress the economy has made. We expect the economy will continue to perform well." The Fed also said they may introduce 3 additional interest rate increases in 2017, up from their previous prediction of 2 raises. Ultimately, rising interest rates are a sign that the economy is doing well. But what happens when interest rates rise? Let's take a look at this chart. The green dotted line represents 5% yield on a 10-year Treasury note. If you look at the placement of the gray diamonds, you'll see that they're most clustered in the upper left and lower right quadrants. What this arrangement is showing is that when rates are below 5%, equities tend to grow with rate increases. When rates are below 5%, equities tend to decrease in response to rate increases. In other words, considering where we are with rates right now, history shows us that we may be able to expect markets to rise as rate increases as long as they stay below that 5% threshold. One area of the market that may stumble when inflation and interest rates rise is fixed income. On the last slide, we saw where the correlation between rising interest rates and a rising stock market. The data also shows this scenario can cause bond yields to rise too. When at first glance, increasing yields might seem like a positive scenario, yields and price, however, have an inverse relationship. So generally, the more yield on bonds it provides, the less it's worth. After experiencing years of low interest rates, Many investors may be surprised to see that their bonds can lose money. But a changing tide in the economy doesn't mean that you have to abandon fixed income altogether. It can be an important part of a well-balanced, diversified portfolio that some investors are needing. Instead, you should pay closer attention to what bond risks and opportunities exist, and closely watch inflation and interest rates in 2017. As always, we will continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. After the December 2016 meeting, the Fed released its predictions for GDP and unemployment in 2017 and 2018. As you can see, they predict that GDP will continue its steady, moderate growth, and unemployment will drop even further to 4.5%. The good news for workers is that unemployment continues to fall in 2017, then wages should rise in response. As you can see on this chart, where the gray line is unemployment and the yellow line is wage growth, the two measures usually inversely relate. So when unemployment goes down, people can expect to earn more for their work. So given all the other predictions, what are the experts forecasting for domestic equities in 2017? Each year, various media outlets compile the SP 500 price targets of Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 this year. Now, these targets are not ours, but it's what these experts on the chart are predicting. As you can see, their 2017 estimates cover a 200-point range from 2,300 to several analysts at 2,500, proof that even the experts have differing opinions. But while they gave a range of results, one trend is consistent. Each and every analyst predicted the S&P will continue to rise in 2017. Of course, as we stated earlier, we're not trying to foretell or forecast or look in a crystal ball. No one knows what equities will do in 2017, and predictions at this stage are still pretty foggy. However, these 12 analysts' perspective shows that optimism does continue on Wall Street. Well, we've gone over a lot of information today, but if you can remember just one detail from the presentation, we hope it's this. Emotions have no place in investing. Over the past 8 years, we've weathered many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all these tests and all the volatility, the market continues to create new opportunities each and every year. As you can see on this chart of stock performance since 1980, the average year had a 14.2% difference between its peak and low prices. That's a big spread. One that we understand can feel quite unsettling in the moment. But even with these intra-year drops, the market has been positive in 28 out of the last 37 years. Last year, we started terribly. And imagine what would have happened if you'd let fear dictate your response. Rather than letting logic and professional guidance help guide you, you would have missed out on opportunities. We expect 2017 to bring an improving economy, but there's also potential for more volatility. So if you feel concerned or you want to understand what's happening, lean on us, lean on me. Please reach out to me personally. We're here for you, and we want to make the most of you, of your financial life. What can you do in 2017 to move forward? Here's some action items for you. If something changes in your life or personal situation, please keep us informed. We want to know. We want to know things like important family events, like births and deaths, but we also want to know health issues, employment changes, any financial developments such as an inheritance or any financial thing that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life that you most desire. On top of specific financial life adjustments, we also want to know if you experience any changes about your feelings about risk, or if you have any concerns about the market environment. We're here to talk through whatever financial questions, worries, or excitement you may have, so we can help you make informed choices and stay on track towards your goals. Finally, we ask that you go over any estate planning documents, beneficiary designations, very important. This is something that should be reviewed ongoing. A well-organized estate is one of the best gifts you can give your family. Throughout 2017, we're going to be focusing on delivering these action steps for you. Number one, keep you informed through regular communication. We are going to continue to have these webinars as well as in-person meetings throughout the year. Manage your investments according to your personalized and customized strategy. And lastly, number three, stay on top of changes in the market environment and make prudent adjustments when necessary. That's the added value that we bring to the relationship. We are going to be proactive and help you every step of the way. Well, now I can actually catch my breath. We've gone through a lot of information and had a very thoughtful discussion. But I'm sure some of you still have some lingering questions. Remember, if you're still wondering or have questions, please call the office, schedule an appointment to meet with me, email me. Let's have a conversation. This is too important to put off for another day. I want to say thank you all for your time today. As you can tell, I'm passionate about helping you and helping you understand the markets and finding facts amidst the hype. For more information and timely updates, please contact us at any time. I'm never too busy to help you. I hope that you enjoyed the information. By the way, a link containing a recorded copy of the presentation will be mailed to everyone tomorrow. So take a look in your email box. At this point, I want to say thank you so much. Have a wonderful day. Bye-bye.